Good morning. You're watching The Market right here on ET Now with me, Ayesha, Faridi, Avanne, Dubash, Nikunj, Dalmia in the studios. And yesterday was a bit of a corrective day. Not really corrective, quite consolidation. We've just been so used to those fabulous moves on the market that yesterday looked like a bit of a step back. And step back it sure was. We did give up that 21K mark as well. In fact, the selling only came in the last hour of trade. And we managed to close in pretty much around the session lows. Having said that, it was interesting to note that it was a buy figure from the FII, so it didn't really smack of any institutional selling or for that matter DIIs as well. But this morning, you've got the GIFT Nifty already indicating an upside of 70 odd points. It seems like it's going to be all well.
Sasha, we are not used to seeing red on the screen. Yeah. So suddenly with so many uptakes and when you see a different color, your eyes would say, okay, what's happening? I think yesterday's market was just a pause, not even profit booking. We saw a little bit of skim from the top. There was no large selling by institutional investors. FI long in FNO has only gone higher. And since markets have been accustomed to this real, linear move post-October, yesterday's market action may just stand out and it may look differently. But in terms of the impact and in terms of the real setup, I think it could be a clear indication that markets yesterday, bulls yesterday decided to take that day off. And I will just not read too much into yesterday's price action. What may happen is that it may just shake some weak hands, some hand on the heart traders who really are playing momentum. They may think twice in terms of the near-term market direction. But the big picture, which is that the rally which started from October end, I don't think that rally has reached its climax. B, FIs who in a sense are the most crucial link to understand which way liquidity is moving, they were not sellers yesterday in the cash market. The FI FNO figure, the long positions has only gone higher to about 61%. So I don't think we should read too much into yesterday's price action at all. It could be a pause. It could be, a couple of, days off for the bulls. They're entitled for a break. And I think I will not read just too much into it. I mean, there is just no shakeout also. Even mid and small cap stocks, hardly any shakeout.
In fact, they were better, barring a few individual cases which had news flow linked to
because you've seen such a linear rally. We are accustomed to see so much of green on a daily basis, 0.5%, 0.25%. That kind of a gain has been so linear that when you see a different direction in the market, it just stands out, it just pops out.
Yep, okay, so it is just about mild consolidation and I think we're quite okay with that, although seeing those red ticks is something that we're not rather accustomed to. Just taking stock of the macros as well as what's going on across the globe, and you had the CPI data as well that came in, and back home we got it later the last evening, where the retail inflation for the month of November has risen to about 5.5%, which is a little bit higher than the 4.4% that was recorded in the month of October. Food price inflation that continued to remain a bit sticky as well at about 8.7%. And you do have as well across the globe the FOMC decision that is going to come out later today. The global markets, US markets are up for the fourth straight day on the trot. US markets are at 52-week highs. But now, is it going to be a dovish tilt from the FOMC, Nikunj?
No. No, they will not do it. Come on. Just think about it, right? I mean, the Fed is maintaining that a long-term target is that we want to bring inflation closer to 2%, and they're just not there. So if you frankly ask me that what is the concern, I think where global markets and local markets in a sense have just made a template that this would be the template for 2024, which is that inflation will not come back. It will not come back. And interest rates will go down at a global level and at a local level. Now that's a template which markets are working with. Any change in that template, I'm not saying the template is going to change, but any change in that template could really lead to some mid-air turbulence, and it really could lead to a sharpish kind of an adjustment. Now just look at crude. It's at sub 70. Yeah. I mean, I'm talking about NYMEX, sub 70. I think post-war it had gone almost to $80. Brent had gone to $84, $85. It's come down to $73. The $20 barrel drop in crude. It's almost a 100 bips decline in 10-year paper. And last evening also the handover in a sense was down. Natural gas is down 6%. And we are talking about winter. Winter is supposed to be a time when demand goes higher. Commodity, energy prices that tend to go higher ahead of winter. And this time it's really the reverse which is at play. So if you frankly ask me, the risk for the market is this assumption that inflation will not come back in a hurry and central banks would cut rates. Now let's take that conversation forward, because Fed in a sense would be coming out with their last meeting for 2023. Ed Yardini joins us now, and let's take a conversation forward with him. Ed, so nice of you to join us. Thank you very much. We've always gone out of the way to accommodate interview requests from ET now, so really thank you for all that.
My pleasure.
Ed, if I say that markets in a sense have assumed that interest rates in 2024 will go lower and inflation will not go back in a hurry, is that a fair assessment?
I think it's a fair assessment. I think there's a couple of reasons why interest rates might come down next year. One would be a recession. That's not my forecast. I don't think the Fed is going to be lowering interest rates because the economy is particularly weak. But I do think that inflation is going to continue to demonstrate that it turned out to be transitory. And I do think that the Fed will get down to its 2% inflation target by the end of next year. We're already down around 2%, excluding shelter, rent, basically. And that's coming down at a slower pace, but it will continue to come down. So I think the main reason why the Fed will be lowering interest rates, see how even I'm stumbling here on which way the Fed's going because things change so quickly. But I do think the Fed's going to be lowering interest rates next year, because if they don't and inflation's coming down, that will be making the federal funds rate in real terms, inflation adjusted, even higher. And I don't think they're going to want to do that. But I don't see 4, 5, 6 rate cuts next year. I see 2, maybe 3.
Yeah, that seems a given, Ed, because the dot plot pretty much is indicating that there are going to be 3 rate cuts next year, hopefully, fingers crossed at that. But, there's many a slip between the cup and the lip. What about the commentary from now up until when they do choose to decide on rate easing?
Well, I think they're going to try to maintain a hawkish stance. I think Fed Chair Jerome Powell in his press conference following the meeting tomorrow here in the U.S. will certainly push back on the idea that the Fed is going to be lowering interest rates next year. He's just going to say that they're not even thinking about lowering interest rates. Remember that famous line that he gave us in 2020? He said, we're not even thinking about raising interest rates. And 1 year later, that's exactly what they did. But I think in this situation, the Fed wants to make sure that inflation is down to 2%. And so even if we get there sooner than expected, I think the Fed's going to be hesitant to ease too rapidly, especially if the economy proves itself to be resilient as it has been.
What could pour cold water on this assumption that interest rates will go down, inflation will not come back in a hurry? Could it be China? Could it be US itself?
Well, I'm glad you mentioned China, because people have had this notion that the only way we can bring inflation down in the U.S. is to have a recession. But the Chinese and the Europeans are doing us a big favor. They're having a recession. And as a result of China's depression in their property market, they're experiencing some deflation, and they're exporting deflation to the rest of the world. So there's 2 major contributors in the goods markets to low inflation and even a whiff, a smell of deflation, and that is China's exporting deflation. And meanwhile, it's turning out that oil prices are continuing to decline, partly because China's economy is weak, partly because European economies are in a shallow recession. They'll probably come out of it by the second half of next year. But for now, this was very helpful in bringing inflation down around the world.
Ed, great to have you on the show. Thanks as always for joining in with that commentary. Let's see what the Fed chooses to do. Not importantly do, but what their commentary is like, what they talk, I think this time is going to be more critical. But let me take it across to Vinny and find out what the global commentary as well has been overnight. Vinny?
Good morning, and let's start a commentary that is coming in from US Treasury Secretary Janet Yellen, who's talking about inflation specifically. We have spoken about the time and again, but now she's highlighting that, she's added that she sees no reason why inflation shouldn't come down to the that is set by the Fed as well as the mandate that they believe in, and they will consistently start seeing the inflation coming down. But she believes that the last mile in returning the inflation to that 2% mark, it's not going to be easy. It's a tough job to actually come down to those levels as well. Certainly, meaningfully, it's coming down, but it'll be gradual and it'll be a tough job to get it down to those 2% levels. Let's move on. Talk about the next commentary that's coming from ECB's Valerie, who is highlighting that Europe actually needs a plan to deepen its financial and economic unity if it emerges from the crisis affecting the democracy as well as society. They need a very bold strategy to overcome these challenges. Industrial policy, fiscal capacity, renewed political impetus are some of the creations that will be required to focus on the European markets and getting an improvement in those terms as well. Lastly, we have a tweet that came in from Peter Schiff as well, and that is on what he's highlighting is that Fed was far more aggressive when it was the goal was to raise the inflation rate up to the 2%. Then it has been actually in getting that target of 2% target and reducing it to that 2% level to the inflation as well. And to raise the rates, the Fed held the interest rates at 0, the lowest rate that was there in the history as well. But to lower it, the Fed has stopped the historical modest rate at 5.5%. So yes, that's the difference he's highlighting, that when the Fed required to actually bring the inflation rate to 2%, they were quite more focused and quite more aggressive than reducing it to the 2% mark as well.
Right, clearly all eyes on the Fed and what it could potentially do later today. Thanks very much, Vinny, for that global commentary. Well, today on the channel, it cannot get bigger than this. On the sidelines of the ET Jury Awards, ET now has caught up with some of the biggest voices of India Inc. From N. Chandra of Tata Sons to Puneet Chatwal of Indian Hotels to Nitin Kamath of Zerodha. And the consensus was that India's growth story is only shining bright. Let's listen in to what a clutch of the big voices had to say.
Yeah, I mean, it's a very exciting moment in India. I think confidence is very high and growth opportunities enormous. Whether it is the manufacturing sector, services sector, domestic sector, export sector, there are enormous opportunities. So it's an exciting time.
From an Indian point of view, I think we have to assume, give or take, the current next year. Of course, the question is when interest rates come down. But we got to be clear that even if Indian inflation moves to, say, sustainably around 4%, which is the target of our system, a interest rate regime of repo rates between 5 and 6% at least is looking the foreseeable on the lower side. Of course, if there are surprises, current rate, of course, is 6.5. Who knows? It could be higher. But I don't think businesses should be really planning on the basis that the base Reserve Bank repo rate is going to be below 5% in the foreseeable future or few years in terms of your planning, and from the current 6.5, and on the higher side, subject to what happens. I think the key issue for India is, I think 100, 200 basis points interest rates is something which we have to take it in our stride as the volatility. The key issue for India is capacity. How are we going to create capacity at scale? And I'm glad we're growing at 7% this year based on the estimates. So most people believe 6 to 7% is the growth rate, which is what we can sustain. But what India needs is 9%.
Okay, lot of interesting voices, and it doesn't end here. We've got lots more lined up as well in the due course of the show. But let's talk markets now. We've got Vaishali Parekh, Kunal Bothra joining in to talk about where the market could be headed today. Kunal, much needed consolidation the past couple of trading days and a bit of a dip yesterday as well. What's in store for us today?
Yeah, so I think it's a good, healthy 100-point correction for the Nifty so far. I would probably expect maybe another round of 100 odd points for the correction for the Nifty. But I think yesterday was also one of the days where you saw profit booking across slew of large cap names. So I think that was one of the major factors. There was no major change in terms of the open interest built up for either of the indices, whether it's Nifty futures or Bank Nifty futures. I think that's the comforting sign so far. The other comforting sign so far is that the premiums for both the futures, that's the Nifty and the Bank Nifty, are still at 0.5% odd for the indices. So approximately 85, 90 points plus for the Nifty and closer to 200 points for the Bank Nifty. That itself indicates that there is no major build-up of short positions with those high or above average premiums for the indices. So net expecting maybe a couple of days of further consolidation, but the bias still remains extremely bullish.
All right, the bias remains extremely bullish. Let's find out what Vaishali Parekh as well makes of the market setup, and maybe a bit of a bump along the way, but the undertone of the market, Vaishali, remains pretty resilient. What are you making of the levels?
Very good morning to all of you. In my opinion, market should continue to be sideways right now because we are seeing a tough resistance at 21,200. And at the most, I mean, if we move past decisively, it could be 21,500. And to match this view, even Bank Nifty is holding on to 47,500 as a tough resistance. So till then, I would take it as a narrow range of 20,800 as support and 21,200 as resistance. And I won't be surprised because just a few days back we saw the gap up opening. So if to 20,800 breaks, then we could slide down to 20,500 also. But till then, it's a wait and watch, and let's hope that 20,800 levels are held on.
Okay, 20,800 on the marker. Vaishali, what stocks are you betting on this morning?
So since a couple of days, I mean, since 2-3 days, we've been seeing that the fertilizer stocks are doing pretty well. So one of them is National Fertilizers, which I'm tracking. So National Fertilizers looks quite good with a stop loss of 76. I'm looking at a target of 88 to 90. That is for National Fertilizers. Yesterday also during the latter part of the day, we saw that some of the cement counters were doing very well. So among which I like Ramco Cement. And also Dalmia Bharat. So Dalmia Bharat could be my pick for the current market price being 23.83, stop loss 2340 and a target of 2930. And one more stock which looks quite favorable, technically well placed, it's Tata Communications. And with a stop loss of 1680, I would be looking at a target of 1800 levels.
All right, Kunal, let's get in your stock specific calls going as well.
So I'll go with larger cap name Bajaj Finance. That's a stock which actually is looking attractive in terms of risk reward. The stock has corrected some 200 to 50 points in the last 1 week, so which makes the indicators a bit oversold as well as the prices or the risk reward a lot more attractive. So it's a rest a buy with a target of 7,550, stop loss at 7,200. And IRCTC is the other stock which has confirmed a breakout yesterday, breaking past about the 765 mark. So it's a rest a buy with 805 as a target, stop loss at 755.
Okay, just looking at some of the individual stocks, Kunal, any trend that you're picking up in the market sectorally? Because yesterday, there was no defining sector which held out or lost.
Yeah, so nothing major in terms of the sector change as well. So in fact, yesterday what we saw was profit booking across few large cap names, but then it was a lot more scattered. Just for example, yesterday we saw HDFC Bank going into a mild correction, Kotak Bank went into a correction, but then the likes of Axis Bank, I think to a larger extent even ICICI Bank recovered quite smartly from the intraday lows. So there was recovery in a few of the other large cap private sector banking names. So no major sector cues is spotted yesterday. And the other part is that no major sector, the open interest changed in terms of individual sectors. That's also putting a perspective that maybe it could just be a one-off correction or a profit booking.
All right, there you have it. All your top recommendations being flagged off by our chartists. Let's move on then. Stocks as well that will be on the radar. We've got Samit right here with us in our studios to discuss that. And let's talk about the major mover, that's PI Industries, and a major entrant now in the key herbicide space.
Well, yesterday's fall, if you see, it was a 10% drop. It was the biggest single day drop that we have seen for PI Industries since COVID. Now, despite the down cycle that we have seen in the chemical space, PI Industries has never dropped around 10% in one single day. But yesterday what happened was a news floated in the market that the key product, that is pyroxylfen, which contributes nearly 50% to the CSM revenue and around 35 to 38% to the total revenue of the company. Now here a Chinese player is expected to add capacity of around 2,000 metric ton. Also along its single largest customer of the same chemical, had also cut its guidance. And because of both of this news flow around in the market, we had seen this drop in PI Industries. But we spoke to the management, and he exclusively told to us that the market news which is impacting PI Industries is completely speculative. Chinese players announce capacities. They also take back that capacity announcements going forward also. So that is not going to impact PI Industries. Also, given the fact that the product is patented till 2025, the impact on profitability on revenue is expected to be limited. Also, if you see, the company has reiterated their growth guidance, which was around 18 to 20% given by the management earlier. Even Nuvama Broking in its notes said that the impact on profitability is expected to be limited because of the contract that they already have with their clients, and also they are also saying that the price erosion of this molecule will also be limited going forward. So they are also not seeing any much big impact. So most likely, can we see a reversal in trade today?
Sumit, I'll tell you why. Because see, one thing is for sure that while near term next 6 quarters nothing happens for them, but ultimately new capacity in China is coming up. When typically China capacity will come in, it will have an impact maybe not on the demand per se, so the volume growth may remain impact, but margins may come under come under pressure per se. Also remember, it's a stock which is, it's a relatively expensive stock, 40 times 1 year forward.
Unlike the other chemical majors.
No, 40 times, Ayesha. 40 times, even it's a fantastic business, it's a great wealth creator. 40 times when you know that capacity is getting created, you would always say that you really want to be in that business where you know that next 2-3 quarters, it's great, but after that we don't know what will happen given that there is a new capacity which is getting created. And this for the first time, I guess, one of the key products of PI in a sense is where the changes at a global level are happening. So yesterday, the panic in the market was slightly overdone, but can we make a case that, okay, just because clarification has come from the company, it's time to just go and grab PI industry at low levels and to go back to its glory days? I think that may not happen considering the whole dynamics.
The other one, of course, is ITC. What are the analyst day takeaways?
Well, in fact, the first physical meet analyst day for ITC, and what they're saying is that on the margins, they're expecting around 80 to 100 basis points of expansion every year on a steady state basis. On demand side, they're saying that the urban demand continues to hold up strong. Rural demand was weak, but they're seeing green shoots, and they're saying that the rural demand has bottomed out currently. On capital allocation, this was one of the concerns for ITC earlier. Of late, it has not been, and they have said that going forward they'll be focusing more on and allocating more of their capital towards innovation. They will be investing behind new vectors of growth like food tech, nicotine going forward, and ITC Infotech, that is the IT arm of ITC. They are saying that management believes that there is big opportunity in this space. Now, they did 2 transformational deals last year, and they are going forward. They are looking to build more capabilities in areas like cloud, where ITC currently does not have any infrastructure. So this will be interesting, or could be interesting for ITC going forward. And they are also open for M&A activities when it comes to the IT part of ITC going forward.
See, Sumit, I look at 2 or 3 things for ITC. One, what is happening to the cigarette business? And I'm referring to the Morgan Stanley report. ITC cigarette volumes are now back to 96% of FY13. Now, cigarette is the cash cow. Cigarette is the high ROI business for them. FY13, post FY13, there has been a linear decline in cigarette volumes. Whatever may be the factors, restrictions, a lot of other factors were at play. But cigarette consumption in India, and right now we are talking about growth coming back. It's 96%. So that means there is expansion in the main, the biggest tobacco business. Then FMCG, where actually they've gone on record and they've said that, look, every year you will actually see a almost 80 bips to about 1% margin expansion. No other FMCG company can give you that kind of an comfort. See valuations. FY25 ITC still is the cheapest large cap FMCG company, trading at about 25 times. So you put all those factors together, I guess it's got ingredients of outperformance. It has been an outperforming stock. Now in this year from 460, 470, Kunal, I think it's 6 months consolidation for ITC already.
Yes, so far, yes. August, I think, is where the stock made a top 496.
Yeah, so the demerger of ITC was announced and the stock topped out. Let me put it this way. Now there is a factor at play, which is the ITC demerger of hotel will happen next year. So that's a corporate event. The cigarette volume is coming back. Valuations are cheap. And FMCG business now, they are really, ITC products are now touching your life. You just think about it, right? From noodles to, just about every major category they're present. They're on the shelves everywhere. And they're confidently giving you margin expansion. So for ITC right now, it's firing full cylinders. Hotels, paper, cigarette volumes, and even FMCG. And valuations are not that stretched. 6 months consolidation, it could be 8 months, it could be 10 months. It's an institutional driven stock. But I think for 2024 also, ITC should be part of everyone's portfolio.
Yeah, Jeffries has got a solid buy there with a 530 price target. So that's perhaps the most bullish one on the street. But Soumya, thanks for flagging off those stocks. Let's take a break, and as we do that, the latest edition of CEO at Work, and Nikunj caught up with Abhishek Lodha, the CEO of the Lodha Group. Let's get a sneak peek into their conversation.
Thanks so much for staying on with us, still tuned into the market. Well, let's put the spotlight then on PI Industries. Talk about the mammoth fall that we witnessed in trade yesterday. Prathamesh Sawant, who is the senior research analyst of chemicals at Axis Securities, now joins us on the show. Prathamesh, thanks so much for taking time out. Just wanted to understand whether, Rainbow Agro's announcement of entering the space with a 2,000-ton, a project approval merited this kind of a reaction for PI Industries. Yes, of course, competition is going to heat up, but how much of a detrimental factor is it really for the company?
Hi, good morning. So firstly, we don't think so at Axis. We don't think so it will have that much detrimental impact to see that kind of fall that we witnessed yesterday, because PI is largely into exporting pyrosulfane plus mixtures of other molecules. So this process has been patented by QMI till 2032 and 2034. So for 7 to 8 years, they have a clear headroom where they cannot be affected by any competition in US and Latin American markets. So that would protect them from any Chinese competition over there. As far as the domestic market goes, PI has a small proportion of pyro, and the pure pyrosulfane in US has been patented till 2025. But a large part of the market in US is keen only as a large consumer market for the pyro plus addition derivatives. So that kind of molecules are more in use over there. So the company will not have a very significant impact of another Chinese competitor coming in, since it's patent protected till 2032 and 34.
Absolutely. And, Prathamesh, that's exactly what Rajneesh Sarna as well told us, offline just last evening, saying that the developed market product will remain patented till 2025, clearly reiterating their previous business outlook and clearly hinting towards Japan. But, all the concern around as to how almost 40% of the revenues comes in from this particular key product. Would you think all that is unwarranted? Would this move and entry of China into this competitive space not eat up into their margins eventually? And then should one looking at buying this dip in PI Industries if it carries on today?
See, I agree with the fact that it is 40% right now, but that is given the fact that the other segments have been not doing well because of the macro situations and the global inventory destocking. So eventually when the other segments pick up, so the ag chem, specialty chem segment will pick up, so this proportion will start looking smaller. So that will diversify the revenues in coming years. And also the company has recently invested in pharma business. So again, that would eventually grow up. So this proportion of pyro of 35 to 40% of the revenues will eventually come down as the company diversifies its revenue. So we are very much confident on PI Industries at Axis, and I think any further dip from the current levels would be a good buying opportunity for long-term investors.
Great. Thank you so much, Prathamesh, for taking the time out and, bringing about this clarity as to how yesterday's move was at best a knee-jerk reaction. That kind of fall is unwarranted, given that patents are already protected up until 24, 25. That's, the early mark that I'm giving out. And it should be a buy if the stock falls further today. But let's welcome on board Sanjeev Bhasin as well and talk about what he's making of the market right now. Sanjeev, let's pick up on the point of, chemicals and agrochemicals as a segment right now? Because there's been quite a bit of correction as well that's played out ever since some of the global majors did cut their guidance. You think this is a space which could be bought now?
Yeah, good morning. So, Ayesha, you have to be stock specific, and we've had SRF and RT under our coverage, which we think are going to be key beneficiaries. SRF is the largest player in fluorochemical. It has a direct tie-up with the likes of Bayer, and their other businesses, particularly nylon cord tire and other verticals, are doing extremely well. So we are very, very bullish on SRF and RT. This news on PI industry, I think there will be some time before it gets digested. But overall, the industry seems to have bottomed out. And if there is going to be progress on the China front in other avenues of destocking being over, then I think this industry on the back of a laggard in the last 6 months can come out to be an outperformer. So stock specific, as a disclosure, both SRF and RT are in our portfolios, and we are extremely bullish on them in the slightly longer term.
Okay, fair enough. That's the view coming in on that entire basket. What about your outlook then, Sanjeev, when it comes to the entire crude oil linked stocks? What about, the ONGCs of the world, Reliance Industries, and some of the oil marketing companies as well?
Yeah, good morning. So oil marketing have been on a tear. I mean, when did you see 30 to 60% gains in a month in IOC, HPCL, BPCL? And I still think there is more steam over there. Also, don't forget the auto stocks on a sentimental basis will do well. So we are very, very optimistic on the oil refining, on oil marketing companies. Reliance has been more of a laggard, but I think that will catch up. And the whole basket of crude underperformance will see a large part of the ingredient users do very well. Paints, tires, even auto. I mean, Maruti will be a key beneficiary. Maruti plant is very near my office. Recently, I just had an interaction, and they said this going away of the Haryana workforce problem is being a big, obstacle which has got removed. If you are aware, the Haryana had put up embargo on outside labor coming into work. So they said that means a very big boon, and their supply chain is doing extremely well. So as a corollary, weak oil prices, or the correlate of that, I would say Maruti is definitely headed to 12,000. IOC, HP are both in our portfolios, and we are very, very optimistic on the oil marketing companies gaining another 20% from here.
Okay, Sanjeev, what's the outlook then when it comes to ITC, given that it was the first in-person analyst meet and it was pretty confident, talking about the company becoming future-ready, rural demand, a stable tax regime as well in cigarettes business is what was expected. How have you read into the movement of an ITC? What does an investor do at 453 levels?
So I think, now the pattern has changed, and that is in the last 1 year, it is evident. From 220, ITC moved to 450, and at the cost of some of the large cap players like a Lever. I still think ITC is going to outperform Lever on a multiple. It still trades cheaper than that. And given that now they are exuding confidence on volumes being back, you are aware, all your Starbucks is... the paper is the cups which you drink are processed by ITC Bhadrachalam. ITC Hotels, which is just 10%, is seeing chock-a-block revenues on their hotel. They have 7,000 rooms over there. And all the other businesses from Agarbatti to matches, ITC is part of your everyday life. So I think that consolidation has been key. And now you could see this stock actually outbeat at least Lever in the near term.
The valuation between HUL and ITC and Nestle and ITC and Marico and ITC and Tata Consumer, I think it's very, very stark. Now, there are two FMCG companies which are giving you positive outlook for next couple of years. One is ITC. Imagine cigarette volumes have gone back to 96% of FY13, and from FY13 the decline in the cigarette volume had started. They've gone back to 96%. And when a business which is a cash cow business, which is, a return on equity and return on capital, which are really north of 50%, if that business comes back, then operating leverage is going to be huge. Second, they're talking about FMCG business expanding margins every year. And third, like, Wazir Saab said, You've got Bhadrachalam, which is ITC, the paperboard business and also the hotel business. They are really firing full cylinders, and it is still trading at 26 times FY25, much cheaper than other companies. Tata Consumer is the other company where they're talking about, uptick in return ratios, marked improvement in their profitability, but it's trading at 70 times or 60 times 1 year forward, depending on the estimate you're looking at. So just one of those stocks which in a sense is still cheap, and I think it's consolidated enough. And we've discussed exactly the same point. What do we have on Mahindra & Mahindra to acquire 60% stake? Gone. Look at it again. 60 points high meanwhile for SGX.
They're going to acquire 60% stake in Emergent Solrin from Mahindra Holdings, and this is going to be for a sum of about 288 crore rupees. That's the news that's come in, and it's a non-government company, just fine. It's a wholly owned subsidiary, by the way, Emergent Solrin of Mahindra Holdings.
Yeah, so just, a little bit of corporate adjustment here and there. Patin Saab, what makes you bullish on OMCs? Is it the decline in crude or pure valuations?
No, both. Pure decline in crude, pure valuations, and Nikunj, they're refining their processing of both hard and soft crude, and the Russian discount, which has made them the numbers be very, very strong. I still think that given you are looking at look at the car sales and so on, and the fuel sales have been humongous. So I still think there is enough room on the upside, given that valuations have been so compressed over the last 3, 4, 5 years, and this is the first time they are coming off their own. So which is why we always thought HAL and BL have topped out or doubled, but the volumes and the growth have been so stupendous, and now their margin of safety is immense with crude in this low band territory. So I think that all three are firing on excellent macros. They're both processing. Reliance just processes soft, and they are doing both hard and soft, which is more to the Indian palate, and that is doing extremely well. So as a disclosure, I think we are in it from much lower levels. So if you are getting in, then the risk, of course, is there that these stocks have come 40-50% in the last 4 months. But I still think PSUs are, particularly oil and gas, this and GAIL are going to do very, very well.
Okay. Stay with us, Sanjeev. Lots more to chat about, but let's take it to some big voices then, and that's what you're going to find all day today on the channel. On the sidelines of the ET Jury Awards, Anisha caught up with Navneet Munod, and he says that India's long-term story looks resilient. Listen in.
No, I think the overall the environment is definitely positive. In India, we should all feel fortunate, and it got validated by listening to everybody here. We are at the right time, at the right place. Of course, the world is facing many challenges on the geopolitical front. There are all kinds of disruptions, but the opportunity for India with the demographics, with the demand, with the digitalization particularly that I think everybody talked about, I think there are tremendous opportunities in India. And everybody feels very positive that we are at a time when almost everybody in India is feeling very confident about the future, and our policy prudence and the agile execution has kept us in good stead over the last several years, and we feel very optimistic about the future.
Okay, very optimistic about the future, but one red flag that Mr. Kamath also flagged out is that one needs to be cognizant that we're not nearing the bubble, right? As far as the financialization of savings and the entire financialization wave is concerned. We, of course, have seen a slew of SIP data coming in, 17,000 crore. The demat accounts are at record high. Is there anything that is worrying you, or not worried about the froth in the market?
As long as investors are taking the SIP route, investing in a disciplined manner, then we don't have to worry. But obviously, if somebody has got, I think, misaligned expectations, then obviously there are always probability of going wrong. But I would argue mutual fund sahi hai, invest in a disciplined manner and think for the long term.
Patin Saab, is it time to take some chips off the table in NSE, not NSE, NSE is not listed, but in, let's say, BSE, MCX, CDSL? Some of these stocks have just gone really, I mean, it's been a linear move in them.
Well, Nikunj, we can argue that case that you can take some chips off, but I think the intermediaries, that is depositories, exchanges, insurance, like yesterday, SBI Life and HDFC Life hit a new high, and brokerages. As a disclosure, I am part of that process. I think they are here to stay for the next many, many years. And as you see, as you are aware that CAMS and CDSL will now see even the your insurance policies get dematerialized. And aside from the holding fees, there is also the transaction cost. So I still think these are very, very good businesses with a longer term view. In the short run, you are right, they may have played out, but I still think particularly insurance companies, the private ones, and brokerages, these are going to head much higher as this whole gamut of equity as an asset class and demats and so on, account openings become very, very key, with participation now reaching 18,000, which is, if you took it on a base, it is just 700 crores a day, which for a country like India is nothing. In the next 5 years, you could even see 5 times that size.
All right, Sanjeev, good to have you as always. Thanks so much for joining in. Let's bring on board then Dipan Mehta as well, who's joining in on the show. And Dipan, headlines seem to suggest that it's been the best ever November sales for some of these auto companies on the back of robust festive demand. What is it that you're making of the kind of moves that we've seen within the auto space?
Good morning, and thank you for having me on your show. I think auto sales are on a roll, and we are seeing consistent improvement because the supply chain issues have been sorted out. In any case, over the past year and a half, the order book position of a lot of auto companies was anyway bulging, and now that manufacturing and supplies have improved, we are seeing those in the numbers as well. But the bigger story, if you ask me, in the auto industry is the rising average selling price of models. So clearly, I think there is premiumization, which is a very strong trend playing out in the auto industry. And even if volume growth is high single digit, the actual revenue growth is translating into mid-teens or even higher, because the average selling price of the models across the board on all the segments, including tractors, is going up. So that's a very positive trend. And of course, higher selling prices means higher margins also. And at the same time, I think we are seeing raw material prices also pretty much benign. And with oil prices dropping, I think it will reduce the cost of ownership. So next few quarters looks very exciting for the auto industry. And some amount of, some amount of that has been captured. But I think the numbers which come through from this quarter onwards will surprise on the upside.
Okay, Vaishali, let's get in a quick take from you then. And why not get in your views on the entire Nifty Bank Index? And within that space, what would be your top picks?
So I would say Nifty Bank. I mean, as I just mentioned, 47,500 is the near-term hurdle. So for now, I would be focusing on Axis Bank, considering yesterday's move. So Axis Bank is a favored stock right now. And as far as a positional trade is concerned, I'm still upbeat on IndusInd Bank, also SBI and HDFC Bank. In fact, for that matter, if you see, Kotak Bank also has been an underperformer. So Kotak Bank, if you see the weekly chart, I mean, it's just the beginning and there is still scope for upside. So the basket would move if we see Bank Nifty in totality going above 47,500. But for now, for a near term, I think Axis Bank should be focused on.
Charlie, good to have you on board. Thanks so much for taking time out and joining in. Meantime, Dipan, let's get in your take then on ITC, owing to the kind of key takeaways that have been told out in the analyst meet, the physical one. Do you believe that the long-term roadmap looks strong? Shareholders should continue to remain a bit patient?
See, I'm not very positive on ITC, never have been. And maybe that's the reason we missed out this fantastic upside. And the reason is that we would classify ITC as a tobacco company and not a FMCG company. And with a tobacco company, it has a lot of baggage and legacy issues and health-related and compliance-related issues as well. So from that point of view, we like to avoid ITC. If you compare, ITC has been in the FMCG business for decades. But you compare the performance of ITC's FMCG business with some of the other FMCG companies, and you will find that it is quite disappointing. They've created the turnover, but the return on capital employed, the profitability has just not matched. And end of the day, after so many diversifications, when I entered the market in 85, since that time, ITC has been trying to diversify its operation and move away from tobacco. But even after almost, 25, 30 years or so, tobacco still remains 80% plus type of contribution, top line, bottom line. And that's one business where volumes cannot be expected to grow, given the kind of, health related issues which are there. So I would avoid ITC at this point of time. There are so many other consumption related stocks that one could look at. And certainly I think ITC may do well, but I'm not so confident of the long-term future.
Dipin, so are you just staying put in this market post the kind of move what we've seen in October? Are you just simply saying that, okay, do nothing, just stick to your positions?
Good morning, Nikunj. I think we are trimming our positions. We are certainly not taking any fresh bets, that's for sure. And the real problem is with professional fund managers who are keeping on getting money into their schemes, whether it's PMS or mutual fund, and then they are forced to deploy it in markets like this. Eventually, when a correction does come, you will see all of these schemes and funds starting to underperform. So, I've seen this many times in the past, and I think it's time to be a bit cautious and take some money off the table, or even if you have fresh cash flows coming in, at least do not deploy them at at these elevated levels. Let's just wait and watch. Corporate earnings need to catch up to the elevated price to earnings multiples which we are seeing just now. We like to see some compression in these price to earnings multiple before we can commit more funds to equities.
All right, let's also bring on board Shivangi Sarda, who's joining in on the technicals. Shivangi, good to have you on board. Let's discuss some of yesterday's winners. How do the charts of HDFC Life and Ultratech Cement look?
Good morning. Thank you for having me on the show. So we've seen that, congratulations, first of all, to all of you for touching new life highs in the indices. We've seen some sort of profit booking at the higher zones. But then again, the insurance space is looking quite positive. Per se, if we talk about HDFC Life, this stock has, given a sort of a good breakout on the weekly frame. And we've seen that this month particularly has been a good month for this stock. We are, heading towards year end also, and this stock has fairly done good on the year-on-year basis as well. So looking quite positive for the next targets towards 700 zones. So one can look out for this stock with a stop near 660 levels.
Actually, LIC has gone up, HDFC Life has caught up, but in the general insurance space, Kunal, I think Star or ICICI Pru Life, they've not caught up, right?
Yeah, not caught up in the same breadth, but there is a rally for even ICICI Pru, I think in the last 1 or 2 months particularly. So I think from 500, it's gone back to 550. But yeah, I think as you rightly mentioned, LIC is the one, in fact, New India Insurance, GIC, they are the stronger price performers, then follows with LIC, and then you've seen pick up in HDFC Life, SBI Life as well.
All right, now IDA, hello, what happened there? Dipin Mehta, it went public less than 40 rupees, 32 rupees. Yesterday, it touched 100. So in less than 6 weeks, it's been a 3x. I mean, this perhaps could be one of the biggest multi-bagger created in the PSU space in its history, right?
Yeah, absolutely. And at these levels, you can't really justify buying a company like IRDA. When it came out, it was well priced, it was a good issue, but when it goes up the way it does, then certainly I think it is amongst the premium valuations within the NBFC space. And NBFC space per se is not like tech space or platform, where you can get 50, 60, 100% type of growth rates. So I'd be a bit cautious at these levels. The valuations certainly seem to be stretched. No doubt, I think the prospects are phenomenal. There's higher and higher investment taking place in renewable energy. They seem to have got the formula right in terms of lending to the right projects and recovering their money. But having seen lending to industry or lending for projects, how sour it has turned, I'd just like to be a bit cautious. See, lending for renewable projects is very different from lending to retail. Retail, the NPAs just come in small numbers, and to an extent, I think they're manageable. But when it comes to lending to projects, the ticket size is much higher. And even if a few projects or a region or a segment starts to underperform, maybe because of government policies, demand supply, we don't know, then NPAs can, suddenly start shooting up. So I'll be a bit cautious in IRDA at these levels.
All right, there you have it. That has been nothing short of, I think, the stock of the week, at least so far. IRDA has clearly been the cynosure of all eyes, crossing that 100 mark. But yes, indeed, lots of big voices then on the sidelines of the ET Jury Awards. Let's hear it out then from Rishad Premji as well as Nitin Kamath.
Look, I'm incredibly excited about the tech sector for the future, right? India today employs about 5.4 million people in the industry. I think that number can double in less than 10 years. And so I'm incredibly excited, one. Two is I think India has really established itself as a talent destination. And talent is the core ingredient of the tech and tech-enabled services world. And so I think if we play our cards right, we can really, really dominate that space in the future. The one thing we've got to focus on and really invest in is how do we skill relevantly, how do we upskill so we move up the value chain consistently. And I think there's great collaboration between industry, between association, between academia, and between government to take that agenda forward. So I'm incredibly optimistic, and I'm not an optimistic person by DNA. I'm much more of a balanced person, but I remain very hopeful. So
I think the entire country has been trying very hard to increase participation in the corporate bond market, and the face value, which was 10 lakh rupees, got reduced to 1 lakh rupees. But I think even 1 lakh rupees was quite high for if you're trying to attract retail investors. So I think 10,000 rupees will make a big difference. I think on the other side, we also need to find a way to nudge corporates to come and do issues at 10,000 rupees, right? Because I think corporates should look at having retail investors as your bond holders as an opportunity to also kind of build on the brand in a sense.
And do you think the current infrastructure we have for the bond market that will be adequate to handle retail participation? We have a very good world-class infrastructure for equities, but do you think that we can scale up for the bond market so that more retail investors can come?
No, absolutely. As in, bond trading can happen on the exchange platform itself. And I think SEBI has already, put a bunch of things in place over the last 1-2 years, with the regulations around online bond platforms. So we have everything in place, and we have, suddenly, the market's also grown in terms of retail investor participation.
All right, top voices, and the show will be sprinkled with a lot more big honchos from corporate India, so stay tuned and listen in. Meantime, Dipan, what about your views then on the entire pharma basket? Recent reports seem to suggest that the pricing environment in the US generics market is going to remain benign in the near term. With the kind of raw material cost environment seeming to be in place, what's the outlook for pharma companies?
No, see, I'm quite positive on pharma. And the reason for that is that I think some amount of competitive intensity has reduced in the US generics market and globally as well. And some amount of pricing relief has come back to the Indian pharma companies. Raw material prices are now, well at normalized levels. Chinese supplies have certainly improved. Domestic market is doing well for pharma companies. And healthcare and spending on pharma and medicines globally, that's not going to go down. It's something which is really secularly keeping on going to move up. And Indian pharma companies will keep finding small niches, new molecules going off patent, and try and focus over there. So generally very positive on pharma. After many years of underperformance, we are seeing good numbers coming through last 2-3 quarters or so. And typically, I think this should last for a few more quarters. Valuations also are quite reasonable in that typically 20 to 30 PE multiple range. So PEGs are about 1.5 to 2 times, which makes them quite reasonable. And very strong, aggressive management, entrepreneurial management, which do tend to, grow the business when the opportunity does arise. So very, very positive on pharma. And even some of the laggards like say Divi's Lab or Gland Pharma, we shouldn't write them off, because end of the day, they are fabulous manufacturing powerhouses. And just need to find the right rhythm and the right products. And when they find those, I think you will see them also doing quite well.
In yesterday's whole market hullabaloo, there was huge price movement in Z. Up, down, volume action, absolutely incredible. There has been a big comeback in metals, Kunal, and it just amazes me. Crude is down and metals are up. JSPL, I think, hit a fresh 52 week high.
Yes. JSPL hit. And on Z, the reason why the stock was all over the place yesterday, because the stock came out of the FNO ban.
Came out and came in again.
Yeah. So for that one day, for that one day, the activity was because the stock was out of the FNO ban.
I think it's back in FNO ban.
Yeah, it's back in FNO ban today.
Then it's quite ironical, right? Crude is down because world is slowing down. Metal is up because everybody expects China to come back. Decide कर लो भाई. Crude या तो ऊपर जाएगा या metal नीचे जाएगा. दोनों क्यों हो रहा है?
I mean, these are all global factors. One really can't say. All we can say is we'll take both these trends with both hands. And if you look at India's listed equity, the lower the prices for metals and oil, the better it is for corporate earnings for a large number of companies. So from that point of view, rather than analyzing why it has gone up, gone down, I want to focus on businesses which are raw material intensive. And I heard earlier in the show, tire companies to an extent which are raw material intensive, even building material companies, consumption companies like electricals, appliances, FMCG companies. I think they will all benefit from lower raw material prices, and a lot of those low prices will be utilized towards marketing spends, and that certainly will grow the volume, will grow the economy as well. So I think it's a very positive trend. Of course, some companies, maybe like ONGCs, some of the steel companies, aluminum companies will feel the pain. But then they're expanding capacities also quite regularly, so it would not be as bad as Street is envisaging. But by and large, I think lower commodities is very, very positive from a corporate earnings perspective. And Nikunj, at this point of time, what we sorely need is the corporate earnings to sustain, even perhaps improve, to justify these kind of P multiples.
Stocks, by the way, which are going to be in focus since we're on the subject of Z just a short while back. Plutus Wealth Management has actually bought 90 lakh shares in Z in trade yesterday at a price point of 292. So that also aggravated some of that movement on the stock. In fact, quite a few block deals. There's a large one on Axis as well, and it seems that Bain Capital may actually be the seller in the block deal that happened. 1.1% equity is on the block for Axis. We've been seeing as to how so many block deals have been taking place of late. There was Mankind Pharma as well yesterday, wherein Beige has actually sold 1.44 crore shares at a price level of 1832 thereabouts on Mankind Pharma yesterday. And then, of course, QIPs and QIP galore. That really seems to be another trend in the market.
And Ayesha, while we may look back at the secondary market number, we are not realizing that how much money is actually moving into QIP, IPOs. That number sometimes does not get registered. There are exits and there are entries. So sometimes you look at the number and you say, okay, FIs are doing this in the cash market, that in the FNO market. But there is a huge IPO market where numbers, sometimes don't get registered. There are a lot of block deals which are happening where numbers sometimes don't get registered. So that's the way it is. I mean, Bank of India, for me, the standout name actually is Bank of India. 4,500 crore. J&K Bank, big numbers. These were banks which had become basket case. Some of the PSU banks, not some, actually all PSU banks had to be built out with a large capital infusion of 80,000 crore where government had to come in at sub-book to ensure that they have enough capital to lend. Otherwise, they would have gone under PCA framework, and a lot of banks did go under PCA framework. From a space of where there were no buyers and the stocks had fallen sub-book, when Bank of India QIP came out, I think there was a mad rush by just about every major institutional investor and HNI investor to really participate. And for me, we talk about a genuine turnaround. See, defense got aided because government is spending. Railway got accelerated because government changed the policy. But banks and PSU banks in my book are a genuine case of turnaround in terms of what the economy has been and how they've really benefited because of that. That's Bank of India for you, 4,500, Sterling Winsell 1,500 and Apar. That's 3. Kunal, let's quickly look at any PSU banks which are looking good for a trade today.
So Canara Bank is something which actually looks very attractive. That's a stock which has not corrected and was one of the first ones to break out right from the point when the stock was, I think, at 250, 260 levels towards the point where the stock is now almost in the 430, 440 club. Bank of Baroda is a bit of a struggler. The stock has not been able to surpass the previous swing highs. SBI is something which is also looking very attractive. The stock is forming a classical triangular pattern on the charts. Then you have the mid cap end of the tier 2 names. The likes of J&K Bank is looking attractive. Bank of India is something which looks fairly attractive at current levels. Union Bank is also one of the stocks which has confirmed a cup and handle breakout in the short term charts.
Okay, that's the take coming in on some of those interesting ideas. But let's get some more mid-cap trading strategies then. Kunal, let's start with you.
So I'll pick a contra name over here. Clean Science and Tech is one of the stocks which is confirming a breakout for itself on the more longer term charts, medium to longer term charts. So expecting a strong turnaround for the stock over the near term. 1550 as a target. Stop loss could be kept at 1400.
Okay, and Shivangi, let's get in your recommendation.
My mid-cap pick on radar is Hutco. We've seen that the stock has been continuously forming higher lows from the last 6 weeks and has been quite resilient with the market. We've seen that even with a small dip in between, it again retraced back, and now buying can be seen with good volumes over here. Good price volume surge indicates that the stock could move higher to 101 zones and with a stop near 92 levels.
Okay, Dipan, we'll let you go on that note. Thanks as always for joining in. Let's take a very quick break on that note. When we come back, the market opened this morning.